Hello and welcome, everyone. Welcome to How to Trade. I'm Shane Vernier. This is FOMC Live. Today we really had a historic a historic event that I think that we're going to be talking about for a long, long time. We had a 0.5 point rate cut today. Dibble, good to see you. Welcome back, everybody. We had a 0.5 point rate cut from Jay Powell in the United States Federal Reserve. It's the first rate cut since our COVID craziness of 2020. I have some serious opinions about this. Arshad, good to see you. Everybody, welcome. I mean, this was an epic event. Let's get right out to price action. You can see we have this New York range, E-mini NASDAQ futures. We have this opening range, sort of talking a lot about that, going back and forth with Connor all day long. I know he wound up on the right side of this trade, so that's absolutely fantastic. Just remember, this is not over yet. This is not over yet. We're watching very closely. I'm still hyper-focused on the bottom of this New York range. I think when Jay Powell begins to talk, it will not surprise me if we do see a big-time reversal. Why? Because we're near all-time highs, guys. And when anytime you're around a huge number like we are, NASDAQ NQ's right up here. Take a look at where we're at. Above last week's high, we're still within striking distance up there, those 21,000. This is a futures contract now. Don't be surprised if we see a big-time reversal here. So I'm watching the NASDAQ closely. Full disclosure, I don't trade the NASDAQ. They're the NQ futures. Some say that it takes a lot of guts to do that. I prefer the the E-mini S&P 500 futures. 5-minute chart, we're going to be watching this relatively closely. Maybe get some scalping done once Jay Powell decides to step in. We've also got a key trade coming into play for the Euro USD. This is like a fastball right down the middle. I'm really excited about executing this trade. I think we're going to get a great chance to do just that. Maybe during the live stream, we had a trade idea out. We're going to recap here in just a second. I know I'm moving fast, but we got a lot to cover. Lorianne, good to see you. Jeanette, good to see you. Welcome, everybody. Samson, good to see you. I mean, a lot of names haven't been around for a while. Good to see everybody back. This is absolutely huge. Jay Ski over on YouTube. Good to see you, Jay. 50-point basis cut was absolutely, I think, wildly irresponsible, but I'm not going to bore you with my opinions. We got a trade idea coming out from right up in here on this short Euro USD. Going to love that as well. We're going to dial this down to real short time frames and scalp them also. And then gold, we didn't get our pullback on gold. We were salivating over this, and now what do we have to do? We've got the breakout. The breakout is now on for gold. I'm going to show you in a second why. I'm going to show you a very important chart why gold is probably going to take off like a rocket, and you can see right there, 5-minute chart. So as Jay Powell talks, we're going to be scouting these markets. We're going to attempt to get a trade, and maybe if we get some good trade location, we'll stack a few bucks. JV Invest, Shane, what's up? Hey JV, how you doing? All right, guys, let's get right to it. Let's get right down to the nitty gritty. If you need a broker, hit Switch Markets, double your deposit with a 100% credit bonus. That's a big one. So if you want more purchasing power, check out Switch. Week 38, big time week. None of it matters. FOMC Live is what matters right now. Jay Powell getting ready to speak here in T-minus 7 minutes. We'll have it for you. Tuesday, Wednesday, Thursday, psychology, all systems go. Full disclosure, I have a trading rule. Last couple Fed days, I've gotten smacked, and I mean smacked right in the face. I don't do that anymore, so I just sort of let that go. I let today go. I got out the popcorn. I was watching a few things early in WTI crude. Didn't really set up for me, so I passed on the day. But if you're trading today, be smart. I'm confident you're up. If you're going to trade your plan, trade it. And remember, once you make the decision to trade, and you're going to trade. Don't sit around and second guess yourself all day. If you're not going to trade, maybe turn the screen off and come back. But if you are in the market, execute your plan. That's what today's for. Does the Fed impact the Forex? Absolutely right. There is no bigger market driver of the Forex markets than the United States Federal Reserve. Remember, a dovish Fed is bearish for the USD. What does that mean? Typically, you see things like commodities move higher. You see stocks move higher, and stocks are an absolute whipsaw mess right now. If you guys are going along for the ride, woo! I love it. That's action. I love it. But boy, I'm itching to get in there, but I know better than that. That's one of my rules. So I'm gonna hang off of that. But if you're in there and you're making money, God bless you. Rack up as much as you possibly can. Take it from the market. Don't give it to the market. That's what happened today. We had a dovish move from the Fed, a 0.5 point rate cut. We're gonna watch Jay Powell try to massage these markets and say, hey, listen, everything's okay. But we did need to cut rates by 0.5 point. I can't wait to hear what he says. That's going to be fascinating. Let me see. Jay made some pips on WTI earlier this morning. Yeah, I just stayed out. If I'm not going to go full leverage and full force, I just stay out. So that's you can make more money in just a few minutes than you can trying to limp through a tough trading day, especially if you're an equities trader. But if you're on the right side now, you're stacking chips. Hawkish. Remember, a hawkish Fed means that it's going to be bullish for the USD. Things like commodities and stocks are going to come down. Right now, we need to be focused on the dovish side of that equation. That's absolutely huge. All right, we had a Euro USD trade idea. I want to highlight this because I think it could come into play for us. This was sort of what we were looking at. We're looking to step up and really sell this thing from about 112.49. And the reason why we were going to do that is because we've got some key levels coming up. I always say, don't forget your key levels. Markets have memories. You have to understand that when we get to these big time ranges, 2024's high, okay, boom, right there. What do you got here? 2023's high. Now, remember, this year's high was established back in August, so it's not that old. I'm not really expecting a tremendous amount of selling right in front of 112, at least not today. Now, what am I looking at? 2023's high. That's big time. That's what I've got right in my mind, 112.75. I want to make sure that I get in on this trade, and that's why we assigned our entry point to be right around there, right around that 49 area. So that's what I'm looking at. I think we could get it. We're only a few pips off. What are we, 80 pips off? That's nothing when Jay Powell begins to talk. We might actually be able to catch the top of this today, and that would be fantastic. So we definitely want to be watching that as well. So that's our trade idea that we're going to have sort of on tap. As far as the Fed decision goes, the verdict is in, 5% down from 5.5%. Absolutely huge move, half a point. One of those that leaves a lot of economists talking to themselves. Politicians wanted more. They wanted 3/4 of a point. I said, why? Why not just cut it down to 0 again? That's what you guys want. The bottom line is this. Inflation is not intact. Yeah, what's my thoughts on gold? We're going to be covering gold, Cam. The big thing I want to say, inflation is not under control. And today, the United States Federal Reserve, led by Jerome Powell and that FOMC committee, they decided that they were going to accept inflation in the hopes of delivering a soft landing to this economy and in hopes of propping up the jobs market. That's it. That's all that today was about. I don't care what anybody says. That's what happened. Reserve cut the Fed rates by a jumbo, the Fed funds rate by a jumbo 50 basis points to 4.75 to 5 during its meeting. The first reduction in borrowing costs since March of 2020. That's it. That's all we need to know. We're entering a new era of finance where inflation is acceptable. All else be damned. I'll tell you what, I am not a fan of today's move. I think this is really going to destroy our markets in the coming months. I don't know. I won't speak for Connor, but we've been going back and forth on this all day long, really all week long, all year long. I think that he's going to have some good stuff for you probably tomorrow recapping this, but I'm going to show you a chart here in a second that should make everybody think that maybe rate cuts aren't good for the bullish side of stocks. The verdict is in right there. There you have it. Since 2020, there was your rate cut to 0. Since then, we've sort of ratcheted up policy, and now we're coming down. Do we come down faster than we went up? Fed behind the curve? Absolutely, Connor. They're always behind the curve, but they're rich. And when you're rich, you can afford to be late, right? We can't. We're retail. We're not rich yet. We're getting there, though. This is a good look at a Fed history chart. I want to show this one real quick, and then we got to get our feet up and running, make sure we've got everything in line. United States interest rate, you can see that's the blue line, okay? This goes way back, but I want to show the tendencies here. You'll notice when we started cutting, and actually Connor showed me this earlier, actually yesterday, we started cutting this thing right in here. We had some rate cuts right around 9/11. Take a look at what happened to your S&P 500. Sort of had a bit of a correction, a sell-off. We started to rebound. Why did we rebound? Rates were low. We started raising rates, and then when did we cut them last? 2007 and 2008. What happened to our markets? They plummeted. Absolutely a big correction. I was there. I saw it. It was ugly. It was very, very ugly. If you're a millennial or you didn't have to live through that financially, I'm jealous. I'm very jealous. I still have PTSD from that era, but we came off big. What happens? Rates plunged, and they took that rate cut down to darn near anything to really get a recovery going. Are we entering the same cycle? There's no way we don't get a correction. I'm sorry. I can't talk like that. I'm not supposed to. We'll get sued by everybody that's watching, but I'm watching really. These markets feel very toppy. All right, here we go. You can see this. This is a gold chart. Now, gold, huge, absolutely huge. Inverse relationship. Remember that. Okay, we start cutting interest rates. What happens to gold? It goes up. And that's tried and true. You can see the curve right there. Boom, as it goes up, sort of keeps a lid on gold. Then we cut, and then all of a sudden price starts to explode. Look out. Okay, here we go. One minute, please. Everything's quiet right now, so our sound should be good to go when it comes on. If it's not, well, I'll just have to translate for you.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy is strong overall.
Thumbs up if you can hear it.
Significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state. Inflation has eased substantially from a peak of 7% to an estimated 2.2% as of August.
All right, thank you,
We're
Lori.
committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a half percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.2% in the first half of the year, and available data point to a roughly similar pace of growth this quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment fell back in the second quarter after rising strongly in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of 2% over the next few years. In the labor market, conditions have continued to cool. Payroll job gains averaged 116,000 per month over the past 3 months, a notable step down from the pace seen earlier in the year. The unemployment rate has moved up, but remains low at 4.2%. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year, 0.4 higher than projected in June. Inflation has eased notably over the past 2 years, but remains above our longer-run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.2% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 2.7%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.3% this year and 2.1% next year, somewhat lower than projected in June. Thereafter, the median projection is 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people.
What about
For much of
prices?
the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. Our primary focus had been on bringing down inflation, and appropriately so. We are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our restrictive monetary policy has helped restore the balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remain well anchored. Our patient approach over the past year has paid dividends. Inflation is now much closer to our objective, and we have gained greater confidence that inflation is moving sustainably toward 2%. As inflation has declined and the labor market has cooled, the upside risks to inflation have diminished and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance, and we are attentive to the risks to both sides of our dual mandate. In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by a half percentage point to 4.75% to 5%. This recalibration of our policy stance will help maintain the strength of the economy and the labor market.
Here's our pullback.
And will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance. We are not on any preset course. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too quickly
There it
could hinder
is.
progress on inflation. At the same time, reducing restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most
That's
likely
nice.
scenario going forward.
That's smoking hot right
If the
there.
economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment, as well as the changed balance of risks. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals.
This is tricky.
If the economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market
Look
were
at
to
that.
weaken unexpectedly,
Data
or
dependent.
inflation
Look
were
at
to
that.
fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation back down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Real nice scalping on gold. Bounce from 38, bounce from the
Steve
golden
Leach with
zone.
CNBC. Thank
This
you
is
for
very
sharing
tricky,
those
guys. Very
in July,
tricky.
You said you weren't necessarily thinking about a 50. You didn't want to be specific, but you said you were thinking about a 50. The inflation data last week came out a little firmer than expected. Retail was strong, third quarter GDP running 3%. So what changed and made the committee go 50, and how do you respond to the concerns that perhaps it shows the Fed is more concerned about the labor market? And I guess, should we expect more 50s in the months ahead? And based on what should we make that call? Thank you.
So, okay, a lot of questions in there. Let me jump in. Since the last meeting, we have had a lot of data come in. We've had the two employment reports, July and August. We've also had two inflation reports, including one that came in during blackout. We had the QCEW report, which suggests that suggests that the payroll report numbers that we're getting may be artificially high and will be revised down. You know that. We've also seen anecdotal data like the Beige Book. And so we took all of those and we went into blackout and we thought about what to do, and we concluded that this was the right thing for the economy, for the people that we serve, and that's how we made our decision. So that's one question. What was the second and third?
How do we make the, sorry, thank you, sir. How do we figure out in the months ahead, is there another 25 or 50 coming in? Based on what shall we make that call? Thank you.
Sure. So a couple things. A good place to start is the SEP, but let me start with what I said, which was that we're going to be making decisions meeting by meeting based on the incoming data, the evolving outlook, the balance of risks. If you look at the SEP, you'll see that it's a process of recalibrating our policy stance away from where we had it a year ago when inflation was high and unemployment low, to a place that's more appropriate given where we are now and where we expect to be. And that process will take place over time. There's nothing in the SEP that suggests the committee is in a rush to get this done. This process evolves over time. Of course, that's a projection. That's a baseline projection. We know, as I mentioned in my remarks, that The actual things that we do will depend on the way the economy evolves. We can go quicker if that's appropriate. We can go slower if that's appropriate. We can pause if that's appropriate. But that's what we were contemplating. Again, I would point you to the SEP as just an assessment of where of what the committee is thinking today, what the individual members, rather, of the committee are thinking today, assuming that their particular forecasts are realized.
This is a range trade, 30-minute range, selling from the top, buying from the bottom, E-mini S&P 500 December.
The projections
Futures.
show that the Fed officials expect the Fed funds rate to still be above their estimate of long-run neutral by the end of next year. So does that suggest you see rates as restrictive for that entire period? Does that threaten the weakening of the job market that you said you'd like to avoid? Or does it suggest that maybe...
It's a good question. Just trying to trick him into saying they're going to cut more.
Thank you.
I think the way I would really characterize it is this. I think people write down their estimate, individuals do. I think every single person on the committee, if you ask them what's your level of certainty around that, they would say there's a wide range where that could fall.
We don't know. Data dependent. We don't know
There are
anything.
model-based approaches
We know
and
nothing.
empirically based approaches that estimate what the
What a
neutral rate
joke.
will be at any given time.
You guys are guessing,
But
Jay.
Realistically, we know it by its works. So that leaves us in a place where we'll be.
We know it by
we
its
expect
works.
in
Let's
the
see
base
if this
case
works.
to be continuing to
This guy's a
remove
clown.
restriction, and we'll be looking at the way the economy reacts
We'll
to
see.
that, and that'll be guiding us in our thinking about the question that we're asking at every meeting, which is our policy stance the appropriate one? We know, if you go back, we know that the policy stance we adopted in July of 2023 came at a time when unemployment was 3.5% and inflation was 4.2%. Today, unemployment is up to 4.2%, inflation's down to a few tenths above 2. So we know that it is time to recalibrate our policy to something that is more appropriate given the progress on inflation and on employment.
Hey, Calvin,
moving to a
good to
more
see you.
sustainable level, so that the balance of risks are now even. And this is the beginning of that process. I mentioned the
I
direction.
trust you're
which
doing
is
well in the
toward,
gold market, Calvin,
a sense
as
of
always.
neutral.
Long time no see.
And we'll move as fast or as slow as we think is appropriate in real time. But what you have is our individual accumulation of individual estimates of what that will be in the base case.
Howard.
Tricky whipsaw
Howard Schneider
trading.
with Reuters.
This is tricky.
How close
Look
was
at this,
in
gold.
terms of the decision? You do have the first dissent by a governor since 2005, I think. Was the weight clearly in favor of a 50, or was this a very close decision?
I think we had a good discussion.
If you're an order block trader,
I talked about this at Jackson Hole, but I didn't address the question of the size of the cut, left it open, and I think we left it open going into blackout. And so there was a lot of discussion back and forth, good diversity of division, excellent discussion today. I think
Right there was
also
our
broad
pullback,
support for the
61.
decision, that the committee voted on. So I would add, though, look at the SEP. All 19 of the participants wrote down multiple cuts this year, all 19. That's a big change from June, right? 7 of the...
getting some pretty good price action
7
off
of
that
them
61
wrote down
anchor.
3 or more, and 17 of the 19 wrote down 3 or more cuts, and 10 of the 19 wrote down.
It's not a
4 or
bad
more cuts.
scalp.
So, there is a dissent, and there's a range of views, but there's actually a lot of common ground as well.
Follow up to that. Now that
111.44 will be the next
you
bid.
give some guidance that
62% of that
sort
30-minute
on the pacing
range.
here,
Euro
would you
USD.
expect this to be running every other meeting once we get into next year? For
Yeah,
example?
we're gonna take it meeting by meeting. As I mentioned,
Here we
there's
go.
no sense that the committee feels it's in a rush to do this. We made a good, strong start to this, and that's really, frankly, a sign of our confidence. Confidence that inflation is coming down toward 2% on a sustainable basis. That gives us the ability. We can, make a good, strong start, but. And I'm very pleased that we did. To me, the logic of this, both from an economic standpoint and also from a risk management standpoint, was clear. But I think we're going to go carefully, meeting by meeting, and make our decisions as we go.
Wow.
Gina.
Wow.
Hi, Chair Powell. Gina Smilik of the New York Times. Thanks for taking our questions.
You and your colleagues in your economic projections today see the unemployment rate climbing to 4.4% and staying there. Obviously, historically, when the unemployment rate climbs that much over a relatively short period of time, it doesn't typically just stop. It continues increasing. And so I wonder if you can walk us through why you see the labor market stabilizing, sort of what's the mechanism there, and what do you see as the risks?
Good question.
So
We're just guessing.
again, the labor market is actually in a solid condition.
With a
And our
non-answer
intention
answer. Yep.
with our policy move today is to keep it there. You can say that about the whole economy. The U.S. economy is in good shape. It's
To
growing
keep it there.
at a solid pace. Inflation is coming down. The labor
Okay.
market is in a strong pace. We want to keep it there. That's what we're doing.
We want to keep it there. Wow.
Nick?
Just whipsaw.
Nick Timmeros of the Wall Street Journal. Chair Powell, does today's action constitute a catch-up in action given recent substantial revisions to the employment data? Or is this larger than typical rate cut a function of the elevated nominal level of the policy rate such that an accelerated cadence could be expected to continue?
Good question. Remember, they revised the jobs down by 810,000.
So I would say we don't think we're behind. We do not think we think this is timely. But I think you can take this as a sign of our commitment not to get behind. So it's a strong move. Sorry, your other question was?
Well, is this about what happened?
means you
in
feel like you're
data
lagging, you're
between
behind.
This meeting and the last meeting, or is this about the level of the funds rate, the high nominal level of the funds rate relative to what might be expected if you're trying to maintain equilibrium?
So I think it's about, we come into this with a policy position that was put in place, as you know, I mentioned in July of 2023, which was a time of high inflation and very low unemployment. We've been very patient about reducing the policy rate. We've waited. Other central banks around the world have cut, many of them several times. We've waited, and I think that patience has really paid dividends in the form of our confidence that inflation is moving sustainably down to 2%.
I'd be looking
So
at
I
bid in
think
the
that is
bottom of
what
this
enables
range
us
in
to take
gold,
this
our
strong
value
move today.
area.
I do not
I wouldn't
think
mess with the
that
Fibonacci's in
anyone should
there.
look at this and say, oh, this is the new pace.
We're going to fill this in.
Have to think about it in terms of the base case. Of course, what happens will happen. So
The
so
clown
in the
icon, I
base
love it,
case,
Jay.
What you see is look at the SEP. You see cuts moving along. The sense of this is we're recalibrating.
Come on, we wanna
policy
trade.
down over time to a
Look
more
at this.
neutral
Look at
level.
this S&P.
And we're moving
Yeah.
at the pace
What do you do with that?
we think is appropriate given developments in the economy in the base case. The economy can develop in a way that would cause us to go faster or slower, but that's what the base case says.
And if I could follow up on the balance sheet. In 2019, when you did the mid-cycle adjustment, you ceased the balance sheet runoff. With a larger cut today, should there be any signal inferred about how the committee would approach end state on the balance sheet policy?
So in the current situation, reserves have really been stable. They haven't come down. So reserves are still abundant and expected to remain so for some time. As you know, the shrinkage in our balance sheet has really come out of the overnight RRP. So I think what that tells you is we're not thinking about stopping runoff because of this at all. We know that these two things can happen side by side. In a sense, they're both a form of normalization. And so for a time, you can have the balance sheet shrinking, but also be cutting rates.
Colby?
Notice the tie. The tie's purple. It's not red. It's not
Thank you.
blue.
Colby Smith with
It's
the
an
Financial
election
Times.
year.
Just following up on Gina's question on rising unemployment.
Fantastic.
Is it your view that this is just a function of a normalizing labor market amid improved supply? Or is there anything to suggest that something
Look at
more
that
concerning
NASDAQ.
perhaps is taking place here, given that other metrics of labor
Dollar
demand have
yen.
softened too? And I guess in direct follow-up to Gina is, why should we not expect a further deterioration in labor market conditions if policy is still restrictive?
So I think
Oh,
what we're
this is
seeing
tough.
Clearly, labor market conditions have cooled off by any measure, as I talked about in Jackson Hole. And, but they're still at a level. The level of those conditions is actually pretty close to what I would call maximum employment. So you're close to mandate, maybe at mandate on that. So what's driving it? Clearly, payroll job creation has moved down over the last few months, and this bears watching. meant by many other measures, the labor market has returned to or below 2019 levels, which was a very good, strong labor market, but this is more sort of 2018-17. So the labor market bears close watching, and we'll be giving it that. But ultimately, we think, we
Weekly,
believe,
38%?
with an appropriate recalibration of our policy, that we can continue to see the economy growing, and that will support the labor market. In the meantime, if you look at the growth in economic activity data, the retail sales data that we just got,
It's a pretty good
second quarter
sell.
GDP, all of this indicates an economy that is still growing at a solid pace. So that should also support the labor market over time. So, but again, it bears watching.
If we get a shot at that in the yen.
Just on the point about
Remember,
starting to see
BOJ
rising
meets.
layoffs, if that were
BOJ's
to
coming up.
happen, wouldn't the committee already be
Could be a good
too
level to
late
play
in
right
terms of
there.
avoiding a recession?
So that's, our plan, of course, has been to begin to recalibrate.
Here we go, golden zone right here.
We're not seeing rising claims. We're not seeing rising layoffs. We're not seeing that, and we're not hearing that from companies, that that's something that's getting ready to happen. So we're not waiting for that, because, there is thinking that the time to support the labor market is when it's strong, and not when you begin to see the layoffs. There's some lore on that. So that's the situation we're in. We have, in fact, begun the cutting cycle now, and we'll be watching, and that'll be one of the factors that we consider. Of course, we're going to look at the totality of the data as we make these decisions meeting by meeting.
Michael, keep.
Michael McKee with Bloomberg TV and Radio. To follow up on that, what would constitute for you
Deleeby,
and the
nope,
committee a
they're not saying
deterioration
anything.
in the labor market? You're pricing in basically by the end of next year 200 basis points of cuts just to maintain a higher unemployment rate. Would you be moving to a more preemptive monetary policy style rather than, as you did with inflation, waiting until the data gave you a signal?
We're going to be watching all of the data, right? So if, as I mentioned in my remarks, if the labor market were to slow unexpectedly, then we have the ability to react to that by cutting faster. We're also going to be looking at our other mandate, though. We have greater confidence now that inflation is moving down to 2%, but at the same time, our plan is that we will be at 2%, over time. So, and policy, we think, is still restrictive, so that should still be happening.
It's still
I'm just curious
restrictive.
as to
Interesting.
How sensitive you'll be to the labor market, since you forecast we are going to see higher unemployment, and it is going to take a significant amount of monetary easing to just maintain it.
So, what I would say is we don't think we need to see further loosening in labor market conditions to get inflation down to 2%. But we have a dual mandate, and I think you can take this whole action as take a step back. What have we been trying to achieve? We're trying to achieve a situation where we
That was a
restore
near
price
miss right
stability
there.
without the kind of painful increase in unemployment that has come sometimes with disinflation. That's what we're trying to do. And I think you can take today's action as a sign of our strong commitment to achieve that goal.
Rachel.
Market's trying to push higher.
Hi, Chair Powell. Rachel
Good
Siegel
luck.
from the Washington Post. Thanks for taking our questions. You're describing this view that you don't think you're behind when it comes to the job market. Can you walk us through the specific data points that you found to be most helpful in the discussions at this meeting? You've mentioned a couple, but would you be able to walk us through what that dashboard told you as far as what you know about the job market now?
Sure. So we'll start with unemployment, which is the single most important one probably. You're at 4.2%. That's, I know that's higher than we were used to seeing numbers in the mid and even below mid threes last year. But if you look back over the sweep of the years, that's a very healthy unemployment rate. And anything in the low fours is a good labor market. So that's one thing. Participation is at high levels. It's, we're right adjusted for demographics, for aging. Participation's at pretty high levels. That's a good thing. Wages are still a bit above what would be, their wage increases rather, are still just a bit above where they would be over the very longer term to be consistent with 2% inflation, but they're very much coming down to what that sustainable level is, so we feel good about that.
Pretty good hit there.
Vacancies over,
Great Britain pound USD
unemployed is back to what is still a very strong level. It's not as high as it was. That number reached 2 to 1, 2 vacancies for every unemployed person, as measured. It's now below around 1, but that's still a very good number, I would say. Quits have come back down to normal levels. I mean, that could go on and on. There are many, many employment indicators. What do they say? They say this is still a solid labor market. The question isn't the level. The question is that there has been change, particularly over the last few months. And so what we say is, as the risks, the upside risks to inflation,
yearly
have
highs,
really come
the
down,
Great Britain pound.
the downside risks to employment have increased, and because we have been patient and held our fire on cutting while inflation has come down, I think we're now in a very good position to manage the risks to both of our goals.
And what do you expect to learn between now and November that will help inform the scale of the cut at the next meeting?
He doesn't know. They're guessing.
More data, the usual.
More
Don't
data.
look for anything else. We'll see another labor report. We'll see another jobs report. I think we get a second jobs report on the day of the meeting, I think. Or no, on the Friday before the meeting. And
we'll have that for you,
inflation
NFP
data,
live.
Data we'll be watching. It's always
We'll
a
be
question
watching for
of
more downward
look
revisions.
at the incoming data and ask what are the implications of that data for the evolving outlook and the balance of risks, and then go through our process and think what's the right thing to do. Is policy where we want it to be to foster the achievement of our goals over time? So
This is tough.
that's what it is. And
Not
that's
many
what we're
trades
doing.
out there. We had a couple on gold. We almost had our right there.
Hi, Chair Powell. Neil Irwin with Axios.
Equities are doing
We've
nothing.
only been running a little above 100,000 jobs a month on payrolls the last 3 months. Do you view that level of job creation as worrying or alarming, or would you
You gonna pull back in the
would you be
Kiwi,
content
maybe?
if we were to kind of stick at that level? And relatedly, one of the welcome trends of the last couple of years has been labor market steam coming out through job openings falling rather than job losses. Do you think that trend has further to run, or do you see risk that further labor market cooling will have to come through job losses?
So on the job creation, it depends on the inflows, right? So if you're having millions of people come into the labor force, and you're creating 100,000 jobs, you're going to see unemployment go up. So it really depends on what's the trend underlying the volatility of people coming into the country. We understand there's been quite an influx across the borders, and that has actually been one of the things that's
We're just looking
allowed
for levels right
the
now. There's not
unemployment
much
rate to rise.
there.
And the other thing is just the slower hiring rate, which is something we also watch carefully. So it does depend on what's happening on the supply side. And on the beverage curve question, yes. So we all felt on the committee, not all, but I think everyone on the committee felt that job openings were so elevated that they could fall a long way before you hit the part of the curve where job openings turned into higher unemployment, job loss. And yes, I think we are. It's hard to know that. You can't know these things with great precision.
Still
but
watching this
certainly
zone down
it
here.
appears that we're very close to that point, if not at it, so that further declines in job openings will translate
68 and a
more
quarter.
directly into unemployment. But it's been a great ride down. I mean, we've seen a lot of tightness come out of the labor market in that form
68.50.
without it resulting in
Look for a bounce
lower
right up
employment.
in there to 72-ish.
Thanks, Chair Powell. Edward Lawrence, Fox Business. So we've heard some speculation that you may be going with the federal funds rate to 3.5%, maybe under 4%. And there's basically an entire generation that has experienced zero or near zero federal funds rate.
Yeah.
And some think we're heading in that direction again. What's the likelihood?
I remember
that cheap money is now the
9%.
norm?
7.5%.
So this is a question, you mean after we get through all of this? It's just a great question that we can
Look at
only
the
speculate
equities.
about. Intuitively, many people
Coming
anyway
right
would
back
say
down to
that we're
scratch.
Not going back to that era where there were trillions of dollars of sovereign bonds trading at negative rates, long-term bonds trading at negative rates, and it looked like the neutral rate might even be negative. So people were issuing debt at negative rates. It seems that's so far away now. My own sense is that we're not going back to that. But, honestly, we're going to find out. But, it feels to me and that the neutral rate is
There's the
is
bid
probably
right there.
significantly higher than it was back then. How high is it?
86.50.
We know. It's, again, we only know it by its works.
And one more, how do you respond to the criticism that will likely come that a deeper rate cut now before the election has some political motivations?
Yeah, so, this is my fourth presidential election at the Fed, and, it's always the same. We're always going into this meeting in particular and asking what's the right thing to do for the people we serve. And we do that, and we make a decision as a group, and then we announce it. And that's always what it is. It's never about anything else. Nothing else is discussed. And I would also point out that the things that we do really affect economic conditions for the most part with a lag. So nonetheless, this is what we do. Our job is to support the economy on behalf of the American people. And if we get it right, this will benefit the American people significantly. So this really concentrates the mind, and it's something we all take very, very seriously.
Here we
don't
go.
put up any other filters. I think if
There's
you
your
start doing
strike
that,
right there,
I
gold.
don't know where you
Ooh,
start.
tough
So just-
area right there. Do you get any bids from that? Do we stagnate or do we get into full reversal mode?
Thank
I would be
you.
very careful. If I was in
Chair
there, I'd probably already be
CBS
out.
News. My first
Got to
question
watch and
is,
see what happens.
just very simply,
Good
what
observation, Calvin.
message are you
DXY trying to
send
recover. It's
American
bringing back
consumers, the
everything.
American
This is
people,
very hard
with
to
this
trade, no doubt about
unusually
it.
large rate cut?
I would just say that, the
Little
US
bit of
economy
hesitation
is in a
here,
good
but this
place,
is tough.
And our decision today is
Got to
designed
scratch
keep it
that
there.
one.
More specifically, the economy is growing at a solid pace. Inflation is coming down closer to our 2% objective over time. And the labor market is still in solid shape. So our intention is really to maintain the strength that we currently see in the U.S. economy.
Equity's going
And we do that
negative.
by returning rates from their high level, which has really been, the purpose of which has been to get inflation under control.
Look at that, US
We're
30.
going to move those down over time to a more normal level over time.
Just a quick follow-up to that.
There's a run right there at the
Listening to
bottom of
you
your
talk
New
about
York
inflation
range.
moving meaningfully down to 2%.
The tide's
Is the
shifting.
Federal Reserve effectively declaring a decisive victory over inflation and rising prices?
No, we're not. So inflation, what we say is we want inflation, the goal is to have inflation move down to 2% on a sustainable basis. And, we're not really, we're close, but we're not really at 2%. And I think we're going to want to see it be, around 2% and close to 2%.
Sort of
for some
stagnating.
time. But we're certainly not doing, we're not saying mission accomplished or anything like that. But I have to say, though, we're encouraged by the progress that we have made.
Right now, we don't have a trending mindset at all. We're looking at chop. We're looking at the market go sideways because the buyers and sellers, nobody can win. Nobody knows what the heck's going to happen. He's speaking in
The
circles.
persistence we've seen in housing inflation. Do you think you can return to 2% with housing inflation where it is?
Complete rotation.
So housing inflation is the one piece.
Let's take a look at crude oil.
That is kind of dragging a bit, if I can say. We know that market rents are doing what we would want them to do, which is to be moving up at relatively low
Nothing in
levels,
crude oil.
But they're not rolling over. The leases
That's
that
a
are
killing
rolling
field
over
right there if you're trading
are not
crude today. That's ugly
coming
stuff.
down as much, and OER is coming in high. So.
Yeah, it looks like we
it's
just
been
missed our
slower
entry
than we
there.
expected. I think we now understand that it's going to take
Yeah, we'll
some
see. We'll
time
get
for
it.
those lower market rents to get into this. But, the direction of travel is clear. And as long as market rents remain, relatively low inflation over time, that will show up. Just the time it's taking now, several years rather than just one or two cycles of annual lease renewals. So I think we understand that now, but I don't think the outcomes
Right down here,
of that
sort of the
again,
bottom
as
of the
long
U.S.
as
session for the
market
Euro
rents
USD.
remain under control,
That could come
the
into
outcomes
play,
of that,
believe it or
doubt.
not.
So I would say it's the rest of the portfolio or of the elements
probably
that
a
go
bid.
into PCE inflation have behaved pretty well.
Probably looking to bid there.
They all have some volatility. We will get
Gold,
down to 2%
rotating.
inflation, I believe, and I believe that ultimately we'll
Stocks,
get what we need
rotating.
to get out of the housing services piece too.
Some of your colleagues have expressed concern that with starting to cut rates, you could reignite demand in housing and see prices go up even more.
It's exactly what's
You
going to
know,
happen.
What's the likelihood of that, and how would you react to that?
The
Gold
housing
wants to
market-
come off, wants to
it's
break
hard
that area.
To game that out, the housing market is in part frozen because of lock-in with low rates. People don't want to sell their home, so because they have a very low mortgage, it'd be quite expensive to refinance.
Oh,
As
what the hell
rates
was
come
that?
down, people will start to move more, and that's probably beginning to happen already. But
All right, there we
remember,
go.
when
right
that
there.
happens,
We are now
you've
long.
gotta-
Here are
you've
the
gotta sell
E-minis.
it,
Let's
but
see
you
if we
also
get that
gotta buy it
rotation.
in many cases. So
Give me a 12-tick click.
you know,
Get up.
Obvious how
This is a
much
tough trade.
additional demand that would make. I mean, the real issue.
Go,
with
go, go,
housing
go.
is
Get up,
that
get
we
up.
have
Get up
had
one
and
time.
Are on track to continue to have not enough housing, and so it's going
It's
to
a big
be
area.
challenging. It's hard to find to zone lots that are in places where people want to live. It's all of the aspects
Look
of
at
housing
that.
are more and more difficult. And,
We got a breakout coming.
You know, where are we going to get the supply? And this is not something that the Fed can really fix.
There's your rotation.
As we normalize rates, you'll see the
Very
housing
nice.
market normalize.
That's
And,
trading,
I mean,
guys.
ultimately, by getting
Wait, wait,
inflation
wait, wait,
levels
wait.
down,
Hit it.
getting
Hit it when it
interest
comes your
rates
way.
Normalized and getting the housing cycle
There you have it.
normalized. That's the best thing we can do for householders. And then the supply question will have to be dealt with
Nice
by
trade.
market and also by government.
Victoria.
Nice little 600.
Hi, Victoria Guido with Politico.
Not bad.
Just following up on some of the
Demo
labor
funds,
market
of course.
talk earlier, you know, monetary policy operates with long and variable lags, and I'm wondering how much
Gold's
you
coming
see
off.
being able to keep the unemployment rate from raising too much comes from the fact that you're starting to act now, and that's
All
going
right,
give
now
you
we
the
want to
room
step back
win
to our
versus
macro
just
levels for
the labor
gold.
market is strong. And then also, if I could, following up on Nick's question.
Right there.
Do you see today's 50 basis point move as partially a response to the fact that
There's
you
your
didn't
premium
cut in
trade,
July, and that sort of gets you to
25.56.
the same place?
Right
So
there.
You're right about lags, but I would just point to the overall economy. You have an economy that is growing at a solid pace. If you look at forecasters or talk to companies, they'll say that they think 2025 should be a good year too. So there's no sense that the U.S. economy is basically fine. If you talk to market participants,
It's basically
I mean,
fine.
you know,
It
business
was
people
fine
who are
until you
actually out
cut
there
these rates.
doing business. So I think
You probably take a
you know,
long
I
right
think-
here.
I think
We're
our
looking for
move is timely.
57,
I do,
56.
and as I said, you can see our 50 basis point move as a commitment.
Hit it.
To make sure that we don't fall behind. So you're really asking about your second question. You're asking about July.
That's a
and I
big
guess
zone
if
right
you-
there for
if
gold.
you ask,
That's a big zone.
You know, if we
See what
got the
happens.
July report before the meeting, would we have cut? We might well have. We didn't make that decision, but
That
you know,
Dom is
we might well have.
worthless.
I think that's not. You know, that doesn't really answer the question that we
That's a
asked
big
ourselves,
level
which
right
is
there,
let's
guys.
look, you know,
That's a
at
big
this
one.
meeting, we're looking back to the July employment report, the August employment report, the two CPI reports, one of which came
Daily
of course, during
38%
blackout,
retracement.
and all of the other things that I mentioned.
that
We're
one
looking at
goes, we're
all
going a
those
lot
things and we're
lower.
asking ourselves, what's the rate? What's the policy stance we need to move to? We knew it's clear that we clearly, literally, everyone on the committee agreed that it's time to move. It's just how fast do you go, and what do you think about the path forward? So, this decision we made today had broad support on the committee, and I've discussed the path ahead.
Elizabeth. Thank you, Chair Powell. Elizabeth Schulze with ABC News.
Sort of looking for
Mortgage
a
rates have
quick
already been
retracement
dropping
back
in
to our value
anticipation
area.
of this announcement.
You know,
How
25.68.
much more should borrowers expect those rates to drop over the next year?
Very hard for me to say. That's from our standpoint.
Pressure's
I can't really
on.
speak to mortgage rates. I will say, you know, that'll depend on how the economy evolves. Our intention, though, is we think.
I'd
that
be
our
very
policy,
surprised if we don't get a
was
bump.
appropriately
Right,
restrictive.
coming up.
We think that it's time to begin.
Don't say the wrong thing,
process
Jay.
Of recalibrating it to
Very
a level
nice,
that's
very
more
nice.
rather than restricted. We expect that process.
Get
to
up.
take
We're
some
going to look to
time.
liquidate right up there.
As you can see in
somewhere
the
in this
projections that we
box.
released
That's where we're
today.
liquidating.
And as if things work out according
Get
to
up.
the forecast, other rates in the economy will come down as well. However, the rate at which those things happen will
Already up
really
$5
depend on how
on the
economy
trade. It's
performs.
already a
We
good
can't
trade.
We can't look a year ahead and know what the economy is going to be doing.
What's your message to households who are frustrated that home
Buckle
prices
up.
have still stayed so high.
You're going to see higher prices at the grocery store.
What do you say to
All right,
that?
Martin, good to see you. Absolutely.
What I can say to the public is that we had we had a burst of inflation.
A burst of inflation.
Many other countries around the world had a similar burst of inflation. And when that happens, part of the answer is that we raise interest rates in order to cool the economy off, in order to reduce inflationary pressures. It's
Let's
not
go. Get up in
something
our
that,
box
people
there.
Experience as pleasant.
Trade right up in here and we're out of it.
At the end, what you get is low inflation restored, price stability restored. And a good definition of price stability is that people in their daily decisions,
There you go.
they're not
There's your
thinking about
pop.
inflation anymore. That's where everyone wants to be, is back to what's inflation. You know, we just keep it low, keep it stable. We're restoring that. So
All right, I'm
what
not
we're
a
going
greedy
through
man.
now, really, it restores, it will benefit people over a long period of time. Price stability benefits everybody over a long period of time, just by virtue of the fact that
That was
they
a
don't
real
have to deal
good
with
trade.
inflation. So that's what's been going on, and I think we've made real progress. We don't tell people how to think about the economy, of course, and of course people are experiencing high prices.
Huge level.
As opposed to
Huge
high
level.
inflation, and we understand that's painful.
Greg.
Hi, Chair Powell. Greg Robb from MarketWatch.com. I was wondering if you could go through, you said just at the beginning that coming into the blackout,
Guess we
there
could have
was an
held.
open thought of 25 or 50.
Got our level.
You know, the Fed could move either 25 or 50. I would sort of argue that when we had those two last speeches by Governor Waller and New York Fed President John Williams, that they were sort of saying that maybe a gradual approach was going to win the day. I mean, I sort of want to ask a 7-part question about this, but
A 7-parter.
could you talk? Would you have cut rates by 50 basis points if the market had been pricing in like low odds of a 50-point move like they were last Wednesday?
Fantastic
You know, after the
rotational
CPI
trade
number
right
came out?
there.
It was a really small
Guns up.
probability of a 50-point cut. Does that play in your consideration at all? Just talk a little bit about that. Thank you.
We're always going to try to do what we think is the right thing for the economy at that time. That's what we'll do. And that's what we did today.
Simon.
Thank you for that. Profound. That was profound,
Thank you, Chair
Jay.
Powell.
Atta
Simon
boy.
Abramovich with The Economist. You've mentioned how closely you're watching the labor market, but you also noted that payroll numbers have been a little bit less reliable lately because of the big downward revisions. Does that put your focus overwhelmingly on the unemployment rate? And given the SEP projection of 4.4
Thanks, Universal. Good to see you.
being the peak in the cycle, would going above that be the kind of thing that would trigger another 50 basis point cut?
So we will continue to look at that broad array of labor market data, including the payroll numbers. We're not discarding those. I mean, we'll certainly look at those, but we will mentally tend to adjust them based on the QCEW adjustment, which you referred to. There isn't a bright line. It will be, the unemployment rate's very important, of course, but there isn't a single statistic or a single bright line over which that might move.
We'll still sell at the top of this range.
One thing or another. We'll look at each meeting. We'll look at
I don't want to buy again.
inflation, economic activity.
We'll sell,
in the labor
though.
market, and we'll make decisions about is our policy stance where it needs to be to foster over the medium term our mandate goals. Yeah, so I can't say we have a bright line in mind.
Matt Egan.
Thanks, Chair Powell.
This is a marathon
Matt Egan from
presser.
CNN.
Holy cow.
I know that you discussed earlier how
Gotta wrap
Fed
this
does
up.
whatever the right thing is and nothing else factors in. But in general, can you talk about whether or not you believe a sitting U.S. president should have a say in Fed decisions on interest rates? Because that's something that former President Trump
He's not going to
from his
answer
point of view,
that.
has previously suggested. And I know
He's
the Fed
not
is
answering
designed
that.
to be independent, but why? Can you tell the public why you view that so important?
Sure. So countries that are democracies around the world, countries that are sort of like the United States, all have what are called independent central banks. And the reason is that people have found over time that insulating the central bank from direct control by political authorities avoids making monetary policy in a way that favors maybe people who are in office as opposed to people who are not in office. So that's the idea, is that, and I think the data are clear that countries that have independent central banks, they get lower inflation. And so we do our work to serve all Americans. We're not serving any politician, any political figure, any cause, any
It's
issue,
silver.
nothing. It's just maximum employment and price stability on behalf of all Americans.
Holy
And that's how
cow.
the other central banks are set up too. It's a good institutional arrangement, which has been good for the public, and I hope and strongly believe that it will, continue.
He almost said, "I hope it will continue." Oh yeah.
Banker, thanks for taking the questions.
A lot going on, Jay.
A couple regulatory developments in the past week that I want to ask you about. First, last week, Vice Chair for Supervision, Michael Barr, outlined his views for the changes to the Basel III Endgame. I'm wondering if you are in alignment with him on what those changes should be, if those have support on the board in a broad way that you're looking for, and if you think the other agencies are also fully on board with that approach. And then yesterday,
That's an
other
epic
banking
range in silver.
regulators-
Epic.
Hold the second question.
Okay, sure.
Let me we'll give you the second question. So the answer to your question is that yes, those changes were
There's our kill
negotiated
zone in the end.
between the agencies with my support and with my involvement, with the idea that we were going to repropose the changes that Vice Chair Barr talked about, and then take comment on them.
That's a pretty good area right there in
yes,
the end to
that is,
sell.
That's happening with my support.
And is there a date for that?
That's not a final proposal, though. You understand? We're putting them out for comment. We're going to take comment and make appropriate changes. We don't have a calendar date for that. And as for the other agencies, the idea is that we're all moving together. We're not moving separately. So that I don't know exactly where that is, but the idea is that we will move as a group to put this again out for comment, and then it'll come. The
Do we
comments will
want to
come
buy
back
gold
60
again?
days later, and we'll dive into them, and we'll try to bring this to a conclusion sometime in the first half of next year.
Right. And then yesterday, there were merger reform finalizations from the other bank regulators. Well, what does the Fed have to do to align itself on merger?
I would bounce that question to Vice Chair Barr. It's a good question, but
It's one way to answer it.
Jennifer for the last question.
Last question. All right.
Thank you, Chair Powell. Jennifer Schoenberger with Yahoo Finance. You said earlier that the decision today reflects with appropriate recalibration strength in the labor market that can be maintained in the context of moderate growth. Even though the policy statement says you view the risks to inflation and job growth as roughly balanced. Given what you've said, though, today, I'm curious, are you more worried about the job market and growth than inflation? Are they not roughly balanced?
No, I think, and we think they are now roughly balanced. So if you go back for a long time,
Next
the
trade,
risks
if we
for
break
inflation, we had
38%, will be that golden
historically
zone
tight
down
labor
there,
market,
25,
historically
30.
tight. There was a severe labor shortage.
That's what I'd be
So
looking at, JV, right there.
Very hot labor market, and we had inflation way above target.
This is a
So,
sticky level, though. I would
that
consider
said
going long
to us,
again.
Concentrate on inflation, and we did for a while, and we kept at that. The stance that we put in place 14 months ago was a stance that was focused on bringing down inflation. Part of bringing down inflation, though, is cooling off the economy and a little bit cooling off the labor market. You now have a cooler labor market in part because of our activities. So what that tells you is it's time to change our stance. So we did that. The sense of the change in the stance is that we're recalibrating our policy over time to a stance that will be more neutral. And today was, I think, we made a good, strong
This yen's
start
coming
on
into
that.
play.
I think it was the right decision, and I think it should send a signal that that we're committed to coming up with a good outcome.
142.49. That'd be a seller right there, 40.
Tip it into recession.
I don't think so. I don't, as I look, well, let me look at it this way. I don't see anything in the economy right now that suggests that the likelihood of a recession, of a downturn is elevated. Okay, I don't see that. You see growth at a solid rate. you see inflation coming down, and you see a labor market that's still at very solid levels. So I don't really see that, no. Thank you.
Thank you.
All right, there you have it. That was a historic press conference from the powerful Jay Powell. A couple of takeaways, a couple of trades that I would definitely be looking at for the next day. We're going to sort of take a look at the Fed watch and what we can expect maybe at the next meeting, what the markets are already anticipating. Nobody has any idea right now because the Fed doesn't know. What we heard was a lot of guesswork. When we began that presser, and it started off with a, we're going to wait and see, we're going to judge it by its works. Now, for those of you that are still watching, that to me, I didn't want to explode and talk over him the entire time then because we need to hear what he has to say. But I'll say that, we'll know it by its works. That essentially means that we're going to try this and see what happens. That's not good policy. That's not good policy. There is no game plan right now. We're going to be data dependent. You also heard Jay Powell sort of, well, we got to look at the data. We got to see the data. That's a cop-out. That means that they don't know how this is going to go. And the truth is nobody knows how this is going to go. What we saw today was a historic rate cut. And that's why nobody really knows how to price this. Now, trading-wise, we executed 2 trades here. We had that gold pull back to 38%. I really liked that one. I thought it was a great trade. We had we could probably execute this one too. We also had the E-mini trade, 2 very different trades, but, we got profitable here. But right here is going to be your sell. So, I'm going to step up to the plate. I don't know, 500,000 units. Why not? Limit order sell. What do we want right there? 142.49 is our zone. I'm going to be looking at 142.40s because I want to be short. So that short limit order in the dollar yen, I like that. Where would my stop out be? I probably would be a little bit leery right now. Probably have it up around 79. Look for that 39 pips 1-to-1. But if you wanted to take a position there, you probably could do it. But I would be very careful. I'd be very careful because right now is when the game begins. Now is when we begin trading. Now is when you're going to see the big guys get in there and say, okay, what did Jay Powell just say? What are the markets going to do? I'm of the opinion that this half-a-point rate cut is a signal that the Fed is going to be better safe than sorry. That's all I got to say. They're going to be better safe than sorry. They're going to want to drop rates right now to try to ward off any sort of inflation, any sort of a big-time recession. They want to deliver that soft landing. They're going to try to mitigate the pain on the American people as much as they can. And then in the next thing, he says, well, pricing stability is number one. And I go, well, if pricing stability is number one, you probably should have left rates high for another quarter and a half, in my opinion. So in my view, this trade's coming our way. I'm sort of going to stick with this live feed and see if we can't maybe get a little bit short here and see what happens. But I do like this. What's our high right there? 142.30, 142.40 is what we're looking to do. So we're in the ballpark. The game's definitely coming our way. Fascinating stuff. I think we're going to get short there. I'm going to be watching that. What I want to say, though, before we go off from a trading perspective, the gold trade, daily 38%, that was huge. That was a great scalp. You don't take a position on something like that because the news cycle is so superheated. Like right now, we're breaking beneath that zone. And one thing I don't like to do is once you hit a big winner like that, I don't like to go again right away. To me, it's sort of like, well, if I was that confident, I should have bet more right at the beginning. Horizontal support and resistance levels are predicated upon orders being there. And what happens is there was a bunch of buy orders there. There was no question about it. Gold came down, spiked up. We got some momentum on our side, and we had a fantastic trade. Came back down. Are those same orders going to be there the second time? The resting orders aren't. The limit orders aren't. The guys like me that just bid that thing and won, we're already counting our money and going to, booking dinner. We're booking spot trips. So what I'm saying is the more times these levels get tested, the worse they perform. So for me, if you get it great on that initial approach, crushed it. So I really liked that trade a lot. This trade right here, this would be a tough one not to take for silver right down there at 29,875. I think you're going to get a healthy bounce off of that. As far as this dollar yen, you see, this is the frustration of trading horizontal levels. Your high right there is 142.30, and you've already come off 22, 23 pips. That's tough to deal with. You just got to stick in there. You got to hang in the saddle. You got to stay on for 8, like the rodeo guys say. Let's see, J-Ski put a blindfold on and throw a dart at a board. It's exactly what they did. The last thing we're going to say is this trade that we executed here in this E-mini S&P 500 futures. This is one of my favorite types of trades. It really is because these types of trades, they win. Now, a lot of you, pretty much all of you, I would say, all really like to get in on trends and get in on big moves and trade great big ranges with 1 to 3, 1 to 4s, and 1 to 5s. That's okay. There's nothing wrong with that. That is what the entire trading community will tell you. You have to get in those great big positive expectation trades, and that's how you make the money. I disagree a lot. I disagree. That's not how I trade, but that's okay. Everybody trades differently. Pick something that's right for you. This is really good. I mean, this was a great trade in my book because what did you have right there? You had a 30-minute bar. You had a 30-minute bar that really showed you a historic Fed movement of a half-point rate cut. It's historic. What happened today was historic. Every time the Fed does this, the markets crash. That's the truth. Okay, so what can we say about that first 30 minutes after that release? It's very important, a very important range. And once we saw that we couldn't really break and we weren't going to trend in the next 30 minutes, you could say that going into today's close, boy, any chance to buy in from that low or sell from that top was probably going to be pretty good. Now, I also said I would sell from the top. I would probably do that maybe for the next 10 or 15 minutes, looking for a scalp trade. But as we get closer to the closing bell ding ding, we could definitely see a directional move. I don't know how these markets are going to close today. I know everybody in the world's trading them right now. A lot of big money in there, a lot of market makers in there right now. We could see a big directional move. So I'm not as confident in that trade, but that first one while Jay Powell was talking, that was fantastic. We'll take those all day. Going back to our dollar yen, we're not going to get that while we're on air. So I was really hoping we could get that. I like that trade a lot. Okay, we got a couple questions, and then I'm going to go ahead and sign off. Let's see here. Arshad Khan, good to see you, Arshad. Welcome back. Shane Vernier, if you have time, can you look at the indices? What I see is all the indices are back to where it started. Yeah, 100%, Arshad. E-mini S&P, we've been looking at this one all day. Let's just go ahead and take a look at the raw indices, the raw index data, and we'll sort of go with our dailies. A couple of observations. Dow Jones Industrial Average. Where are you? You're at all-time highs. You're at all-time highs. What was your high? Was right up there at 41,981. I think we had a trade ID out. Connor had one out earlier, potentially trading this to the short side. He was absolutely right. I don't know if they got filled up there. That's always tough. So what do you have right here? You got a doji setting up. Absolutely, Samson. Have a great day. You got a doji setting up. So the last two sessions, what do you have? You have a value area that's sort of set up right there around 41.725 for this Dow Jones. So when I look at something like this, I would say we don't know what the heck's going on. We don't. We have a value area. In my view, I would be watching today's low very closely and look for a big sell-off tomorrow. I don't know that we're going to get that. Don't hold me to that. I'm not trading that. But what I am trading is I know how I want to trade. I know that this moving average, my 13-day moving average, is going to come right up in here and right around that 41.2 and a quarter is going to be a kill zone for me, potentially to look long in the Dow tomorrow. Absolute compression, though. 30-minute chart will tell the story, guys. We'll tell the absolute story. Bollinger Bands are tight. There's your news. There's this talk. And what are we doing right now? We're just chopping sideways. We're annihilating the folks that bought in thinking this was a trend day up here. We're annihilating the folks that thought that this was going to develop into a sell-off. And it's turning into a complete mess. Unless you have a range trading strategy like the pendulum that we teach in the room, you don't trade stuff like this because you're going to lose, almost guarantee it. All right, S&P 500, let's go ahead and take a look at that. Same thing. We've been looking at this E-mini stuff all day. It's going to be the same basic type of a setup. I would say a little bit different. You'll notice that the S&P 500 did touch those all-time highs, and now it's sort of reversing coming off. We're buying in the money puts right now and looking for a significant pullback here in coming months. But as far as going into tomorrow's trade for the S&P 500, it'd be really difficult for me not to step up and really execute the same type of strategy I just showed you. I would be buying dips, scalping dips, not taking positions on dips. My long side bias that's really been in place for since COVID is now gone. I'm officially a bear in this market. You can write it down and book it. I think that we're going to start to see the wheels turn for the next year or so, 6 months to a year, and you're going to see, if not flatlining prices, you're going to see a pullback, and I think that if it's under 15%, I'll be disappointed. That's the way I see it. And then also the NASDAQ. Here's your NASDAQ. NASDAQ's a little bit different. You can see there's your daily. You sort of got a W there. If you like the daily W, boom, there's that. There's your pullback. There's your second. So you got that buy-in right there. I don't know if I like that W, but, there it is. It's huge. As far as how I would be trading this one, let's go ahead and take a look at a little bit different scenario here for this NASDAQ. There's your big sell-off that we saw back towards, really, was that end of July? Then we got the bounce, and we came up and sort of flatlined. So the biggest thing that I would look at is the last significant trend, something like that. Where are we at? Sort of 62%. We went up to 78%. It will not shock me if we grind sideways, make one more push up here, and then you get the big pullback, or we could pull back from this area right here. I just don't know. I'm pretty sure the S&P. Well, I was right about the S&P was going to go up one more time and touch the tops. The Nasdaq doesn't necessarily have to. It was really the one that was the leader of the pack. So that's how I see the indices. I hope that works. Janet, good to see you. Let me see. JV selling at 42. Yeah, I believe there was check out the trade ideas. In the analytics post. I think that's definitely what you want to look at there. Okay, guys, just one more thing I want to touch on before we sign off here because it is important. Okay, what do we got? Okay, that was today. What do we got next? In November, what do we got? FOMC Live in November. Are we even posting odds for the November meeting? Nope. Look, the website's not updating. Do you guys think that that's an accident? Let's try it now. Let's see if it works now. This is always how this works. Absolutely. Now they took it down. Where is it? Where's my chart at? I love it. Always remember that when the markets get a little bit dicey and nobody knows what's going to happen, you start to see all these technical errors. Don't worry. I'll have something written up for you the next day or so. All right, guys, that's it for today. That was a marathon stream of about an hour long. Reminds me of the old days. We used to sit here all day long and look at markets and things. But that was a while ago. All right, so it's good to see everybody back. Saw some old faces in here. Some old friends decided to drop by today. Always a pleasure to bring you guys these types of events. What we saw today was history. It was a 0.5 point rate cut in an environment where we have record high inflation. Our CPI is still pushing all-time highs. Pricing stability hasn't been restored. We're not at 2%, and we saw a 0.5 point rate cut. We have a bubble in housing. We have a bubble in our stocks. This was a very big tipping point for the financial markets. I won't get into the political end of it because I don't think Jay Powell's a political guy, but he did wear a purple tie. Remember, Reds, Republicans, Blues, Democrats. He made sure he wore a purple one just to say, hey, we're apolitical. I don't know what's going to happen now, but I like the short side of equities. As far as our commodity prices go, I think we just guaranteed that they're going to churn higher. Gold's going higher. Crude oil's going higher. Silver, I was listening to some guys today that said silver's going to explode. Next big event for us is going to be NFP. There's going to be a lot of emphasis on jobs numbers now. And then we'll start talking about the November meeting, and then we're going to start talking about the November election. So we got 2 sets of job numbers before the election in November, or at least, well, 1 set. We get one in October. And then, that November 5th will be the first week. I don't know. I'd have to look at the calendar. But it's going to be tough, guys. This is going to be good trading. You can make more money in the next 6 weeks than you can sitting there for the next 6 months if you do it right. We're going to see some big moves. Today is exactly what we're talking about. Buckle up. Uncertainty is the new rule. Jay Powell admitted we don't know what the heck's going on. Judge it by it works. Well, I'm going to judge you guys by your works. Make money. Make money every day, and you'll be just fine. That's enough from me. You guys have a fantastic trading day. We're going to be back tomorrow. Tomorrow's going to be an epic day. If you're going to trade one day this week, trade tomorrow. All right, everybody. Till next time, trade the action well, and we'll talk soon. See you.